All right, good morning, everyone. Thank you for joining. We appreciate everybody taking some time out of their day to join this webinar and get a little CPE and hopefully learn a little bit about budgeting and forecasting. So we've got a good hour of content today, and we're looking forward to speaking on the budgeting, forecasting, and a lot of the experiences we have and what we're seeing in the marketplace currently. And hopefully a lot of the things we're going to talk about today resonate with you guys. So I think before I do introductions, just wanted to say, Andrew and I will be switching off slides and talking about our experience and speaking to the content. But also, as we go through anything, if you have questions, we would love to hear from you guys and make it as interactive as possible. So if there's anything that strikes a chord and you want to make a comment or throw a question in the chat, please do. And we'll be monitoring those throughout the webinar, and we will answer them as quickly as we can and try to get to everyone. So with that, I'll introduce your presenters today. My name is Davey Parsons. I am a partner at Forvis Mazars. I've been with the firm for a little over 5 years now. I lead our outsourced accounting services practice out of Nashville, Tennessee. And our practice focuses on a number of industries, but we spend a lot of our time in hospitality. So forgive me if you hear too many hospitality examples today as we go through this. I'll try to make it a little more generic in that regard, but that's where I spend most of my time. Before joining Forvis Mazars, I spent about 6 years in industry as the CFO of a Nashville-based hospitality group. And being CFO, leading the accounting and finance function, we spent lots of our time working on enhancing the budgeting and forecasting functions of accounting and finance, ultimately to produce higher net income, better results, reach the goals for the company. And that experience in industry is now what we have brought to Forvis Mazars, and we spend most of our time now in various industries doing a lot of similar work for clients, consulting on the annual budget process, the budgeting throughout the year, forecasting how those sorts of things can help improve the business and reach goals. And also presenting with me today will be Andrew Horo. He has a very similar background to myself, spent a lot of time in the private sector doing similar things, budgeting, forecasting, full accounting and finance function, but also has a deep knowledge of the nonprofit industry as well. So we hope to cover all of our bases today as we're speaking on these topics, not just in the private sector, but as it pertains to nonprofits to an extent. And really any industry related question is on the table today. So if we are talking in a way that maybe doesn't speak directly to your industry, shoot us a message and we can discuss any topics that may relate better to you. So those are our presenters, and what we really want to cover today is a little bit of background on how your previous performance can impact budgeting and forecasting and sort of where you are as a business in your maturity cycle. Speak to how accounting and a timely month-end close is really crucial to having the information you need to prepare a proper budget and rely on that information. And then lastly, identify the most significant impacts on revenue primarily, because that's usually how the budget process starts and what informs the budget process for the most part. So we'll identify some significant areas there, but we only have an hour. That conversation could go on and on. So again, if there are specific questions you have or issues you're running into with your specific budgeting process, please let us know and we'll speak to that. So before we dive in, I'd like to go ahead and throw out a polling question just to sort of get a pulse on why everyone's here today. What are your focus areas as it pertains to budgeting and forecasting? So what is your primary focus when it comes to budgeting? We've got financial planning, cost control, forecasting, revenue forecasting, and then just overall strategic planning. So we'll give you a minute to answer that, and then we'll...
And I guess, Davey, just to chime in here, I know on the nonprofit side, cost control is what we see, just because resources are really so limited and they're just trying to get by any way they can. On the hospitality end, where do you see budgeting as the most important part? What are people looking for?
Always looking for higher EBITDA, I mean, whether it's just generating more operational income for the owners or the shareholders, or creating an environment of efficiency where your operation is attractive to a third party and you're pushing towards an exit. Ultimately, budgeting is one of the most important aspects of reaching those goals. So it's a good question. So a little bit of a mixture here. I think financial planning sort of speaks to what I said overall. A little bit of a delineation from strategic, which has more operational aspects, but absolutely, just like personal budgets and personal finance at home, you're only going to reach your objectives if you plan and have discipline around that process. So glad to see that's the highest interest today, and I think we'll be able to cover those topics well. So without further ado, we'll move from the polling question and we'll sort of dive right in to budgeting and the fact that there are almost unlimited types of budgets that can be approached. It's not just we want a 5% increase in revenue and how are we tracking year to date versus that. There, as you see here, variable budgets, product line specific budgets, funding specific, and then operations and cash flow budgets are probably the biggest bucket and more what everyone spends their time on. But we did want to go through these other various aspects as they are important and they do ultimately inform operations and cash flow at the end. So when we're talking about variable budgets, this could be a number of things, but when I'm thinking about variable budgets, a lot of times it speaks to expansion or contraction potentially. Let's say we've got 10 operations in various locations, and in the coming year, we expect to go from 10 to 12 or 10 to 13. As we are approaching the annual budgeting process, we have historical revenues, we have historical performance, but now what we're saying is, as we enter the new year, we want to increase efficiency, increase revenue, improve our operations overall. But now from a capacity or a volume standpoint, we're going to have 20% more on the top line. If that occurs, what then do we need to prepare for so that we can execute on the delivery to our customers to continue to ensure that our brand maintains the status it's at or even elevates it, and we are prepared in a very explicit, visual, granular way to understand what that growth could mean to the performance of our operation overall. On the flip side, as I'm sure a lot of you have experienced, sometimes we move into new markets and it doesn't work, or potentially a stalwart of a market, the neighborhood may have changed, or something could have moved in that now increases competition, and maybe that location is not as much of a boon as it used to be. So a lot of times moving into the new year, not only are we considering expansion, but there are strategic moves like closing a location or altering its primary purpose, whatever that may be. Again, that speaks to the variable budget process, and there are going to be palpable changes, whether expanding or contracting in our overall business model. And from a revenue standpoint, we need to be prepared to understand how does that impact the rest of the income statement, the balance sheet, and generally the overall performance of the business. Product line specific budgets, sometimes similar conversation to what I mentioned above on variable, but this could be something like not necessarily expansion of regular operations into a new location. It could be that we're going to try out a new service line. And again, in the hospitality world, this could mean something like we are going to really invest in catering in the coming year. So we're going to look beyond the four walls for revenue increases, and we're going to move into an entirely new segment that we have not been part of before. So how do we understand what our costs and our investment is going to, how do we understand the investment and the cost required to make sure we are poised to have the impact that we want to have. Again, on the flip side, you could have also expanded into catering or opened for lunch when potentially you're only a dinner operation, something like that. Maybe that's not working. Maybe in the coming year, that product line specific budget needs to be evaluated for its overall effectiveness, its overall viability, and how do we expect these additions or contractions to our service line to impact our budget. So not just expansion of regular operations, sort of a different way of doing business, making sure we understand how those changes are going to impact our overall organizational structure. As we move to funding specific budgets, and this is a little more in Andrew's wheelhouse, I will say on the for-profit side, this could be something like construction, joint ventures, something potentially where there's going to be a significant or very identifiable new source of capital, and then also a very identifiable sources and uses of that capital. How are we managing our ongoing operations while also being hyper-focused on this more project-based budgeting and performance tracking? So funding specific really has to do oftentimes with a project-based outlook, whether it's construction of a new facility, expansion of manufacturing, or in the nonprofit space, this is much more prevalent. As you know, if you're in the nonprofit sector, you are getting funding for specific programs constantly. So the budgeting of the fund specific in the nonprofit space is really important. Andrew, anything you want to add to that before I go into operations?
No, I think you kind of hit the nail on the head, and we see a lot of organizations in the nonprofit space when they're thinking about budgeting. You kind of have your business as usual, but like you said, where you may want that expansion, or I know I was in microfinance when we wanted to open a new branch, we would budget for it, but it was all contingent. We needed, I think at the time it was like $3 million in outside funding to like fully commit to a new area. So that budget would kind of sit independently. And that way, if we got the funding, we had the funds and could activate that budget, but it didn't affect our day-to-day operations. So really separating out those new revenue streams until they go online, we found success with some smaller organizations that are in that growth stage, so that you're not robbing your core business to fund growth.
Great answer, great insight. Thank you, Andrew. And then finally, and we'll move on from here, the operations and cash flow budgets are maybe just a fancy way of saying budget. This is what most people are used to spending their time on and focusing on, is the operational budget, which looks a lot like an income statement or a P&L or a pro forma, if you're familiar with that when you're entering into a new venture. These operational budgets are effectively your realistic, somewhere between realistic and ideal scenario for the coming year. We can speak a little bit about the virtues and or folly of being ambitious with your budgeting, but ultimately we want to try to be as accurate with the coming year and the data points that inform our budgets as we possibly can. We don't want to set something unrealistic that then creates bad morale within the company because we set objectives too high and we were unable to meet them. But also, you're not going to accomplish what you want to accomplish if you set lazy or easily attainable budgets. So there's certainly a fine line there. So the operational budget encompasses a lot of these other things and brings really the budgeting process together. And this is month to month what you're really going to be relying on to track your performance against your expectations and your hopes. And then the cash flow budget is separate but equally important. Operations speak to performance, but they don't speak to liquidity, solvency, growth from a financial resources standpoint. So having a cash flow budget that sort of rides shotgun with your operational budget and makes sure that we have the financial capacity needed to execute on our objectives is just as important as understanding your performance itself. So that's sort of just laying the foundation for what we plan to discuss today. And I will move on to the next slide and let Andrew take this one from here.
Yeah, and thanks. And I think you hit on the good. There's a ton of different ways to budget, and those were just a few of them. And every organization has their own way and their own way of budgeting. And I know there was a comment in the chat that I'll address is just how do you know when you should move out of Excel into these systems? I actually sit on our nonprofit digital technologies team, and this is a question we get asked a lot. And it really comes into what do you hope to get out of budgeting and how much kind of cost goes into your budgeting to think about and what's the benefit you can give. Because I think what we saw in the first poll question, there are many reasons to budget. And I think once you get out of kind of that P&L budgeting to that forecasting, that modeling, that's when we see clients really have success getting out of Excel and into some of these more modern platforms to do outside of what traditionally anybody outside of finance would think of budgeting. When you're doing this forecasting, that scenario planning, or any of the type of kind of segmented budgeting we were talking about. But no matter what you're doing, where does the budget start? And I mean, David comes from the outsourced accounting. I come from outsourced accounting and advisory. Any good budget starts with a good monthly close. And you're listening to a bunch of accountants say that, so you're probably just shaking your head going, of course they say that. That's all accountants seem to care about is a monthly close. But it really is true because most organizations, if you're a calendar year end, you need to have your budget done by December 31st, which means you're not working with final numbers when you're saying, okay, what happened last year to predict next year? And thinking about, so most organizations I work with start a year-end budget process 3 or 4 months before year-end. And so they're starting to think about in August, they're setting those priorities, they're figuring out where are we growing, where are we contracting, everything Davey just talked about for about 15 minutes. Those are usually set before that budget starts and how we're going to do it. Then there's the budget process. It's either on the nonprofit side, it goes to a board. On the for-profit side, it's going to go to investors or owners for kind of that approval or blessing and make sure we're working with something that's going to be realistic throughout the year. But thinking about where those numbers start with, if I'm starting my budget process in August, but my monthly close is 3 months behind, that means the starting point for my budget is May. That's only 5 months out of the year. If I am a business, let's just say you are in toy manufacturing, and you know when the busy season for toys is? It's Christmas. But if you're only budgeting May for that year, you're not going to know, and maybe you haven't even closed the books for the prior year. You're not going to have those numbers, and you're going to be working with numbers from 2 years ago. So thinking about how to accelerate that monthly close, if we can start a budget process in August using July numbers because we've closed our books to the best of our ability, it gives you a leg up. And also, if you have that, we hear a lot these days about continuous close or sped up close, automation. Having those close at every point in the budget, you know what? We started the budget with July numbers. We've closed August. Let's just refresh because we're using a tool or our Excel is set up properly to drop in new actuals. It's just going to give your company better data to work with. And the more up-to-date, fresh data you have, the easier it is to make insights and to figure out what's actually going on. The organizations we work with, I work with a lot of them that just don't close monthly. They close at the end of the year for an audit or for debt reporting or grant reporting on the nonprofit side. And when they go to budget, they're pretty much just working off the prior year's budget and not adjusting for what's actually happened. And I think being able to give those up-to-date actuals to see what's going on, and especially when you're thinking about, we were talking about cash flow planning, and we'll get into a little bit later on that, seeing when the bills are actually coming in. Like if we know we work with this vendor and they don't bill us for 30, they want their payment within 30 days because that's what they do and they will stop work if they don't. We need to plan that in our budget. We can't just expect we're going to have those go overdue and thinking about, okay, are we going to have the cash funds in? Having that up-to-date information just really allows your company to plan properly and know what's going on. And having that up-to-date picture of the company, the last thing you want to do is kind of present a budget based off of incomplete information. And then we have so many organizations get into even February and realize how wrong their assumptions were. A budget is built off of assumptions. And if you do not have up-to-date data, the assumptions are going to be wrong. I always made a joke when I was in industry because we had an FP&A team, is that I was accounting. I was in charge of yesterday, our treasury team was in charge of today, and FP&A was in charge of tomorrow. But my FP&A team, they were great and can make the best models ever. If I didn't deliver them up-to-date numbers to plug into those models, all the work they did was meaningless. And you can have the best people, the best insights, the best market research about where you're going to go. If you don't know where you've been, you're doomed to repeat your same mistakes. If you know, hey, every time we open a branch, we think it costs us $1 million. You know what? We looked at the last 3 we opened. It's really 1.3. Well, if you don't have up-to-date numbers and you keep budgeting $1 million, you know what hits your bottom line? A negative $300,000 every year, and that adds up for most companies. And as Davey was talking about, one of the things he sees is let's get that EBITDA as high as possible. These types of things are just going to come into play and are really going to hurt your bottom line, which then in turn hurts your growth and what you're able to do. So that having been said, figuring out how to get your monthly close, and we always say when we go into new organizations, on the advisory side, unfortunately, I only get called when things are on fire. So usually they haven't closed in 6-9 months. I'm sure, Davey, you see some of that too when you get called in to kind of bring in the full accounting team. And it scares you, but at the same time, figuring out how to get processes in place. There's so much automation out there. There's so many tools that are available that there's so many tools that's being added even into your general accounting package you might have right now. I mean, I've been to a bunch of conferences this year. All of them have some form of generative AI, some form of OCR recognition to get data in so you can analyze. Just even without bringing in new products or new people, just seeing what you have to add to that automation to get to that close quicker, and finding that, I always say accounting is that common ground between accuracy and timeliness, and figuring out where you need to be to close your books. Like I said, I was in microfinance. We did about 50,000 $72 payments a day. There had to be a balance between timeliness and accuracy for me to close my books, because if we tried to chase down every single payment and tie it out, we never would close a single month. So finding out where that tolerance for us wasn't, yes, during the rest of the month, we did tie everything out. But figuring out when to close my books, to give it to my CFO, to give to my board, to give to my CEO was key so that they could make decisions for the next month. The last thing you want to do is give them outdated information to make decisions off of, and it turns out that's all meaningless because of what's happened that hasn't been recorded. So going back to the theme of this slide, the budget starts with the assumptions. The assumptions almost always start with your actuals that have been recorded, which in turn goes back to how is your accounting team producing that? How can we do it better? How can we get more timely data? And that really just leads into so we have our timely data, and I'll turn it over to Davey. Just what is a clear budget process and how would people go about that? Oh, sorry, polling question number 2 before that. What's the biggest challenge you face in budgeting and forecasting? And we just talked about a big one is data accuracy. The other one I see a lot in the nonprofit space is letter B, that collaboration across departments. I know when I went into industry from public accounting, I was the outlier that knew numbers front and back. Everybody else was so driven by the product and the program that it was hard during budget season because I had to be the bad guy. So there were times I closed myself off because I was the one who had to make the cuts to present. But that hurt me come at the end of the year because they just did what they want then because they didn't know why things were cut. So we see a lot of that. The more people you can bring to the table, it just makes it easier throughout the year when you have to budget and reforecast. What do you see, Davey, as the biggest challenge when you go into your clients?
Oh man, it's a lot of these, but I'm interested to see how this comes out. But I like the lack of flexibility. I do see a lot of very traditional and perhaps even antiquated budgeting processes, and you can see it only got 3.9%. It's sort of a nuance that I think is underappreciated. The ability to be nimble and be flexible with your budgeting, and that will sort of roll us in to the next slide. But also, we had a question come in that was, I think, timely to that. How frequently should budgets be reviewed throughout the year? I thought that budgets are outdated on January 1st since things are always changing. I really love that question. And, it is going to be contingent sort of on your business and the nuances. I think if you are a business, I'll just throw out something like, Cracker Barrel or a big name brand who has similar operations and they've been doing this for, I don't know how long they've been around, 40, 50 years or something. I imagine their budgeting process is extremely tight. and is being reviewed monthly along with the financial statements, but maybe not altered that frequently because of how mature that business is. Don't work for Cracker Barrel, not a shareholder, have no idea, but just using them as an example. I would say businesses that are somewhere between startups and middle age, not quite mature, going to need to have a good deal of flexibility, I would say, because things are changing so quick. So as Andrew mentioned, we really need to have accurate and timely records to be able to build proper assumptions. But for me, I think budgeting really is a tool to work to coalesce your entire team. And this goes into this slide of have a clear budget process, who should be involved, finance, management, operations. It really gives your entire organization a set period of time throughout the year to not just have your heads down in the weeds, serving customers, executing on objectives, but to take a step back holistically and bring all of these teams together and discuss what's working, what's not working, what's ahead of us. And we really need to come to consensus here on how we want to proceed in the new fiscal year, new calendar year, whatever it may be. And laying out the budget really is the blueprint for that. And I feel like the budgeting process gives organizations a chance every year to come together across departments, reacclimate with what everyone's doing, have a common goal that we are now refocusing on, and push forward. So who should be involved? I mean, all the major stakeholders, ownership, management, those can be the same in some instances. Operations is an absolutely imperative function of budgeting. It makes no sense for accounting and or the FP&A function to look at historical performance and lay out unrealistic expectations. That only sets your organization up for bad morale, turnover. Not a good idea. I think operations should really lead the charge with the guidance of management. Ownership and management should come to the operations team and say, here's what we're being told performance was last year. We trust these numbers from accounting and finance. Here's really where we would love to be, but we need to hear from our operations team, who at the end of the day are the ones delivering on the results of this budget. How realistic is this? If it's not realistic, can we speak in very specific terms about why that isn't? And perhaps we can problem solve and still get there? Or what are the resources required to get to this process? So again, to sort of summarize that, I think it starts with ownership and management. And then ownership and management really need to do a good job of listening to their operators. We might have a lot of operators and or finance people on the call today, maybe not quite as many owners. So that's more of just a public service announcement for ownership. It's really, really important to trust and listen to your operators always, but particularly in this budget process, absolutely imperative that operations has a huge hand in it. And then obviously accounting and finance are going to be the team that are taking the operational and ownership objectives and putting pen to paper and laying out a plan over the next 12 months as to how we're going to accomplish this. And then the goals and the objectives, that's primarily going to come from ownership and management, but this also speaks to just a great time every year to say, our goal last year was to expand market share by 25%. That's going to be our focus. We may, in the process of expanding 25%, experience some attrition. Maybe things will get a little loose from an infrastructure standpoint, but we're willing to accept that because we believe market share expansion in the current year is our most important objective. Great. That's what we focus on in the prior year. That's been our goal. Now it's time to circle the wagons and say, we just fell short of that objective. We got a 21% increase in market share, but still right on target for where we would want to be. Tons of growth were experienced last year. Now this year, we need to be focused on tightening up processes, becoming more efficient, becoming more cost conscious, increasing our margins now that we have higher top line. Just a great time of year to sit down, refocus with the operators, and the key stakeholders and understand really what are we trying to achieve this year and what is the plan for getting there. And then the timeline basically is just what is the plan? When does it start? When do we expect to start seeing results? And in terms of the ability to be nimble and be flexible, I think at a minimum, the budget needs to be ready to go at an absolute minimum before the first close of the new year. I mean, I think that's actually getting fairly delinquent. You probably want to have it wrapped up for the coming year before the end of the current year. And then every month when you're reviewing financial statements, there needs to be a budget to actual component of that. And the results of that budget to actual inform, do we need to make adjustments to the budget? Because the budget, if it is just a static, literal interpretation, no room, no wiggle room, sometimes for mature companies that can work really well. Oftentimes, I think that can lead an organization down a path of unrealistic expectations, given where you are in the year, whatever it may be, that again can lead to not having success stories internally, not boosting your team. It can be a morale killer. So I think the budgeting process needs to be fluid. It needs to be informed by up-to-date, accurate information. And if you are really ahead of pace from a revenue standpoint, I think it's totally reasonable to make an adjustment a couple months in, maybe quarterly, to the revenue side of your budget, see how that trickles down throughout your organization, and reset expectations based on the new reality. Or if we're way off our revenue expectations, it may be that we push headcount to Q3 versus Q2. All of those things are very regular course of business, and from my opinion, are advised if you are actually having a good bit of volatility in your business. And usually that means you aren't in as mature a cycle as some other businesses. So then one way to sort of have a sanity check, if you're new to budgeting, this is great to understand industry benchmarks and how they can inform your process. Even if you're not new to budgeting and you've been around for 30, 40 years, still the best finance teams are paying close attention to industry benchmarks and how those are changing. Those are also not static, just like your budget is not static. So, again, in the hospitality world, when we talk about restaurants, you don't want labor as an industry benchmark exceeding 32% of your gross revenue. You don't want your cost of goods, your food, beer, liquor, wine costs to exceed 30%. And in combination, that gives you a 62% prime cost. That's been sort of an industry benchmark, roughly, depending on your style of service, for a while. So understanding those elements in your industry really give you a good starting place for budgeting, but it doesn't speak to the reality of your particular deliverable in your particular environment. And you really have to be careful about balancing the great insight and sort of parameters that industry benchmarks can give you, and potentially striving for something that isn't aligned with your specific offering, or sandbagging, basically saying, wow, industry standard is 32% labor, we're hitting 31, we're beating the standard, why focus any harder on this? You could be in a labor situation that's significantly more advantageous than what the industry standard is, and you could be missing out on 5 to 6 margin points at the bottom line just by getting lax, relying on industry standards. So they're super important to stay up on, and I think that's why we want to, in whatever industry we're in, go to conferences, stay in touch with the publications that are being put out there, because that really gives you the current status of where these benchmarks are. Because like I said, they are not static, just like your own annual budget is not static, but super helpful to understand within your industry what are the rough parameters, and then being able to distinguish within this industry, where do we have a competitive advantage, and maybe where do we have a competitive weakness, and creating your budget and your expected operational performance around like maximizing your advantages and trying to mitigate your weaknesses. Got a couple more questions here, but I'll let you jump on into this slide, Andrew. We can address as we go.
Yeah, and keep the questions coming. I think, unfortunately, Davey and I do talk a lot about budgeting, so I think we have a lot to say. So even if we don't get to the questions now, we'll definitely follow up with some answers and can have some conversations, but feel free to keep them coming. If we get to it at the end, we will. I don't want anybody to hold back. Makes it a little more interactive. But as we've said, so we've said why we need to budget, how to budget, what are some good first step, which is monthly close, but really what are those key ingredients that go into a budget? And I think it's also going back to some of the stuff we're talking about is why are we budgeting, to think about what needs to go into it. Obviously, in any good budget, we're going to put that historical data and we're going to try to bring in its up-to-date actuals, historical trends from what we know, and how it is. If we can bring historical references or that industry benchmark, we can try. Like the example I always give is sometimes you don't know what's going on. The first budget I ever did with myself was for the calendar year 2020. So we had a great budget process in November of 2019, and then I'm sure everybody knows what happened in February of 2020. And we ended up, at my microfinance institution, we rebudgeted every day for 3 months. We would look at cash flows and we would rebudget and figure out what we could cut and what we could keep. And I'm sure that happened to a lot of organizations in every sector, but we had no historical data to know what was going to happen tomorrow. We were an organization that required people to be in person to make loan repayments. And now no one could be in person. There was no historical data. We just had to rely on projections and just keep refeeding the most up-to-date data we had. So it's kind of, when we think about what are those key ingredients, it's what is available. And these are some of the things in a perfect budgeting world. You think about my historical actuals and what I know about opening a new market, opening a new product, buying a new plant, opening a new hotel, opening a new catering business, increasing hours. I can use that historical data. Thinking about what my projections are, and I think projections are key. I'm an accountant by trade. I'm always going to be conservative. Now, I understand sometimes you want to present that zero balance budget or that balanced budget or show a profit, but when you do projections, also think about what's going to be realistic. I know there's a tendency to kind of show the best picture to an owner, to a board, to an investor, but I've found that usually comes back to bite most people unless you are highly successful in thinking about how we can be realistic with those projections. Or even, as we said, in the different types of budgets, maybe we budget the different scenarios and just show that and be able to show, here's our bad case, neutral case, good case, just so people understand what we're doing. But really thinking about those projections is key and how they're going to filter into that budget. Next thing is, what is the strategic plan? And I know there was a question about thoughts on a rolling 12 to 18 month budget to forecast, but what is that 5-year plan for the company? Is there expansion? Are we just, hey, let's hold the fort for a few years and kind of rebuild what we have, fortify our core business, and then expand? Knowing where the organization or company is going, I think, is key to building an annual budget. Do we need a surplus? Because you know what? Next year, we are investing heavily in a new market, and we know we're going to have losses, so we need to build up that reserve. Or we are going out on the road and attracting new investors, so you know what? We're going to strengthen our core so that our financials really look good for our roadshow. Knowing where the organization's going, I think, is key to kind of set those, as David talked about, what are those goals? What is the plan for the year? Knowing where it's going, I think, really helps get to where we should be this year. And then obviously the last one is, in any type of FP&A, any type of accounting, cash is king. So do we have the cash flow to even enact a budget? And I think there was another question there that I think gets to the heart of this is, do you prefer a 3-statement budget, which is balance sheet, income statement, and cash flow, or a P&L budget? The most successful companies I know do the 3-statement, and I'll tell you why. A lot of companies, a big portion of their spending is going to be on fixed assets. That's where a lot comes from. Outside of salary, it's that investment in building, leasehold improvements, trucks, manufacturing, what have you. If you're just budgeting your P&L, there's a chance you either forget it or it becomes an afterthought. And really doing that 3-statement and actually budgeting based off that cash flow statement. How much cash do we need in the door? What do we need from an outside investor to just fund this new factory that we know could be a booming success? We just need to build it. So thinking about that from a three-statement perspective really helps the most successful companies I know, because then you're looking at the big picture. If you're just looking at the P&L, hey, I budget my P&L, but it turns out my debt increased by $5 million. And maybe that's hidden in interest expense, and we're paying enough already that no one really notices, but it's not giving management, those decision makers, investors, that full picture of what's going on. Now, there are reasons not to do it, but I say full transparency, that three-statement budgeting. When you think about cash flow, when you think about debt, you think about all the scenarios a company can go to, that's where you're going to get your most information and be able to put the most things out there. And that, obviously, when it comes to budgeting, the more data you can use, the better. Whether it's historical, whether it's industry, whether it's projections that are tried and true, whether it's new voices in the room. You bring in new people in your operations to open a new plant, or you're going into a new market. Find somebody from that market. Is it a market where you're going to have to hire people from within to make your sales because it's just very close-knit community? Or is it somebody from the outside can come in and have success? Knowing these things just will allow you to really make those informed decisions. And I think a lot of what we've talked about up until now is really on that expense side. And when I think of budgeting, before I got into the point of my career I am, that's what I thought a budget was. It's that personal budget. What am I spending? But I think a big thing in, I think, all our industries is, what is the other side of that? Where are the inflows coming to? And I think, Davey, you're going to take us through kind of that revenue projections and ways to do that. And I think you probably see that a lot in your industry.
Yeah, absolutely. And I guess just to bounce back quickly to the question about the income statement versus the three-statement budget. I mean, a lot of times the budgeting process is a reflection of how robust your financial reporting process is on a monthly basis. So I think the question was that we're a mature business and that we're really only focused on the income statement. I think a good way to get to a place of having a three-statement budget process is to continually, on your monthly P&L reviews, begin to incorporate the balance sheet and the cash flow, which is difficult a lot of times for owners to understand and then therefore give the time to. But the example Andrew gave about interest expense versus full debt service payment is a perfect example. We used to see a lot more trouble with that when money was basically free over the past 15 years, before recently, interest expense was such a nominal concern that your P&L performance may look fantastic, but your cash flow may really be suffering because the overall debt service is so high. You may be showing net income, have interest expense of $3,000, but have a $23,000 debt service payment. Pretty significant discrepancy there between what's being charged as an expense, which is what registers with most business owners as cash outflow, versus a full debt service payment. So I would just say focus on making sure your financial reporting incorporates those aspects, balance sheet and cash flow, as well as P&L, and that will sort of begin the educational process to get buy-in from ownership and operations to include those three statements. But jumping back to revenue here, in my experience in the private sector, I would say revenue informs the entire budget process for the most part, because the volume of your revenue is going to impact your cost considerations. So I think that is where a lot of times the real spirit of budgeting can be missed. I think a lot of times people think budgeting is, companies approach budgeting as cost reduction. How do we slash? How do we get more efficient? That's important, but I think truly understanding your revenue and having a good projection there will give you a significant advantage and put you in a really good position to project the rest of your expenses and ultimately the three financial statements we spoke of, a good projected P&L, balance sheet, cash flow statement. So understanding your customer base, first bullet point here, is our customer base sustainable? This is a good question, and this makes me think of Peloton during COVID. I'm a Peloton user myself, but you may or may not be familiar with the brand. It's like an at-home spin studio type cloud-based thing. During COVID, couldn't go to a gym. The sales for this product went absolutely through the roof. I mean, I think they were up 300 or 400% in revenue or something year over year. So the business basically built out their manufacturing and their staffing and a number of things to meet current demand on what probably should have been a pretty clear limited spike, not a sustainable business model moving forward. And, you know, when you hear Peloton now, probably what you've heard in the past couple of years is just layoffs, stock price reducing. You can rent bikes now versus having to purchase. So they made a mistake of sort of building their operations and their growth off of a unsustainable revenue model. So that's a pretty like real world current example of how that can be a very negative impact. What do we have in terms of guaranteed revenue? What is our churn rate? These are maybe a little easier to rely on if you're a subscription based, maybe a software as a service type company or publications or whatever it may be, where you can know exactly 3 months, 6 months, 12 months out what sort of contractual revenue you have coming in. Also can be a little easier on the nonprofit side when we're talking about grants and various other federal funding that can stretch out 12, 18 months in advance. A little trickier when it's manufacturing, hospitality, you know, anything retail where you can't necessarily count on the same customer yesterday buying the new product that you produce. But you do definitely want to be very in tune with, as we are evolving, as we are improving our model, what is our attrition? How did we get to the place we got? What is it that our customers like? What is it that they are asking for? And being very in tune with your customer base will inform your current revenue, which will also help you project where you're headed over the next 12 months. And then as you see in projected growth, we talked about this a little bit earlier. Are we going to expand? Same operation moving into a new market? Are we going to add catering? Or are we going to add a new service line that's above and beyond just the operational components we have currently? And in the world of inflation we've been in over the past 2 years, are we raising prices? The answer's been yes, 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 almost every quarter. But you also have to be conscious of what is the ceiling to my market here, not just my cost components are getting so expensive, I have to raise prices. That can quickly put you out of business if your competitors are savvy enough to understand the market ceiling for our price is what it is, even while our costs are going up at a higher clip and we can raise prices. You're going to have to be more clever further down the income statement than just pricing yourself out of the market. And then, you know, the external factors, to the extent you can manage them. We work with some restaurants down in the Houston, Texas area. And over the past 5 and 6 years, there's been such a surge of, no pun intended, but with tropical storms and hurricanes, I mean, it's just a regular occurrence. It's not once every 10 years now, it's almost every fall season. So that's an external factor that has become so prolific every year that it has to be considered when we're budgeting. We expected these months to be down in revenue because we're going to expect a week to 10 days in Q3 of power outages that are going to mean we don't have revenue coming in. What are those aspects in your business? If you live in Chicago, January, February is going to be snowy. It's going to be hard for people to get out and generate the same revenue as throughout the rest of the year. And that really speaks more to seasonality, potentially, than external factors. And then, you know, if you're not a Fortune 500 company and you don't have a big lobbying budget to keep regulations and tax impacts on your side, and you're just lowly small to medium businesses like most folks, and you just are at the whim of those sorts of things, staying ahead of that, talking to your consultants, your financial advisors, getting a sense of what those impacts could be and staying ahead of them also very important just to the overall performance of your business. Sorry, we slipped this polling question in quick, but Excel is going to continue to be the largest platform for budgeting. It makes a ton of sense for small and medium-sized businesses. There's still lots of functionality, lots of power within Excel, especially when you add in some additional tools, Power Query, some other aspects of Excel that can really get you there. So, I mean, it sort of depends on your sophistication with Excel. There's some decent sized businesses that still rely on it for the foundational components of their budgeting, but there are certainly ERP systems, specialized softwares, a number of other things that can make that process a lot easier, make it significantly more efficient to move from year to year, or as I spoke about earlier, just being nimble within the period and making adjustments here or there. Absolutely can bring tons of efficiency and cost savings. Kind of just depends on, you know, the size and sophistication of your business there. So moving on from the revenue projections informing your budget, we've got a couple of slides left and we'll try to reach all your questions. But let's just go through a quick review and we'll try to address any questions in the last few minutes we have here.
Yeah, thanks. And then the just on the polling question, I think you're right, Davey. I think Excel can be a great tool. I would say if you ever get to the point I did when I was in industry where my CFO would ask, can I see the backup? And I just went, no. Because during COVID, I had 6 sheets that spread across many tabs, and I just wanted no one to see how the sausage got made. That maybe it's time to maybe look past Excel if you're afraid of what's going on behind the curtain. But I think for most companies, it's a great tool that can help you budget. But I think where your ERP or budgeting system can help is what we're talking about here, is that budget reforecasting and review. And being able to look on a periodic basis, okay, not just what are my budget to actuals, because I think a lot of modern accounting systems come with that budget repository. So you can plug in your budget, run the reports and see how you're doing. But thinking about, okay, we're 3 months, we're 2 months, we're a month into the year, where any of our assumptions just totally wrong. Let's say you're a landscaping company that relies on snow plows in the winter, and you get through January and it does not snow where you are. That means you're not getting revenue during the winter. Do I need to redo my entire forecast for the year because I lost a month of money that I usually expect? So thinking about that when you're thinking about budgeting and reforecasting, thinking about, as Davey said, I think I've heard you say the word flexible a lot during this hour, is that reforecasting, being able to be flexible. I think a key to this process is being able, as management, as somebody who does a budget, to admit your assumption was wrong. Rather than keep moving forward with a bad assumption, if you get a month, 2 months into the year and you realize, you know what, this new location is just not working out. Not that you should abandon it, but let's adjust our projections so that our budget ends up being realistic. I think part of this is it's a little bit of a guessing game. You hope to make an educated, scientific guess and be right, but being able to look at partway through the year and depending on how big your company is, what stage it's in, being able to be flexible and go, you know what, we're going to adjust this up or down based on what we're actually seeing, rather than just keep going back to our investors, going back to our board, going back to our owners with the same outdated budget that we know is wrong. That there's nothing wrong with that, and being able to recognize that and adjust on the fly, I think will make your company more nimble and agile and be able to kind of move forward and kind of beat out some of your competitors that might not be doing that. So that about wraps us up. We just hit the objectives again. Hopefully you can see how historical information and that seasonality can impact your budget, and thinking about how to get those numbers in there, how a timely monthly close and the most up-to-date data is so crucial in a budgeting process. Having a good starting point is going to give you a leg up on all the competition. And just how revenue and how projected revenue can just change, and what factors can go into that depending on your industry. And that will, as we answer some questions, I'm just going to launch the last poll here. Would you like to be contacted to see if we can help? Like Davey said, we come from different industries. I think as a firm, we hit just about any industry you could possibly think of. So if we are not the ones to talk to, we will make sure you get put in touch with the experts who can really help you and have that industry expertise. Any questions in the chat, Davey, that you want to make sure we address before we run out of time here today?
Yeah, we'll just take one more. And man, really good questions. Andrew and I do a lot of these, and sometimes it's cricket. So happy to see a lot a lot of questions coming in and intelligent questions. So we're not going to be able to answer them all today, but what we will do is take these questions. We have information for the individuals asking, and we will reach out individually post-webinar and answer your questions. But one of the last ones I think we can get to, do you usually see most cost as a percentage of sales or try to justify each one independently and individually? That's a combination. I would say that's where I usually start. That's a great place to start, is as a percentage of revenue. And again, I just am in the hospitality space so much that is just totally relevant because volume drives most everything. But when you think of something like occupancy costs, so let's say you're either locked into a lease or you're locked into a mortgage. But for the lease standpoint, in an individual operation, you do compare it as a percentage of sales. But this is where the industry benchmark conversation comes back in. Historically, you would like that to be 12% of your total revenue at the absolute max. But since asset prices and interest rates have remained so high over the past couple of years, a lot of new operations are seeing very painful occupancy cost percentages, maybe 15 to 20% sometimes. And so that's an example of how an industry benchmark shifted to a new reality. We want to compare that cost to total revenue, but also if your occupancy cost now takes 20 cents out of every dollar, you're also going to have to shift your business model to make sure that you are running your cost of goods or your labor model is so efficient or whatever it may be that you can claw back those margins that are slipping with something like an industry standard like occupancy costs compared to sales going up. So long answer to yes, typically I would say most things start as a percentage of revenue, but there is a consideration for a lot of line items that aren't as simple as just I bought the raw materials to produce a finished good that is sold at a margin of 20%. As you move on down the income statement, not everything is as clear cut as a volume-based decision like that. And so I think that may do it.
I think we're at time, but thank you everybody for joining us, and hopefully you can take something away and you learn something. But thank you for taking the time.
Yes, thank you. And any additional questions, our information is here. And like I mentioned, we will reach out to those who had questions that we couldn't get to today. And really appreciate everyone's participation, and we'll look forward to seeing you on the next one. Hope everybody has a great day and a good weekend.